Hello, everybody, and welcome to this session. We're going to talk about a topic which I find personally quite fascinating. That is how sovereign debt is actually delivered to the market, how it is issued, and also a little bit on how it is traded subsequently in the secondary markets. Well, the reason why I like this topic is that it gives us the opportunity to go and visit a couple of websites to see actual data and information on what is being done by different governments around the world. This is generally speaking in the public domain, so you'll be able to, even on your own, go and inspect websites that I'm going to show you, or websites relevant to your country of residence, to see what your government does in this area. So the thing to appreciate is that typically when sovereign governments issue debt, be it short-term or longer-term debt instruments, they do it via a public auction process. That is more or less, it doesn't have to be the case, but that is more or less the norm in the majority of countries around the world. And investors are invited to participate in such auctions, and they place bids, they place offers to buy. Now, I want to base this discussion as much as possible on real life examples, as I said. So what I've done is I've already opened up some websites, and the first one I want to show you is the German finance agency. Germany is a big European issuer of high quality debt securities. And this is the website of the German federal sort of finance agency, the body responsible for conducting these issues, and you'll have similar bodies elsewhere. Sometimes it's the Ministry of Finance who does this, the Ministry of Treasury or Department of Treasury in the United States. In the UK, you've got the Debt Management Office, who's responsible. And I'm recording this video on the 22nd of June 2024. It's Saturday morning, but quite recently, as you can see, there were some auctions being held via which the German government sold public debt or sold government debt. And up there at the top you see an instance from the 19th of January, sorry, not 19th of June, not January, of the Germans selling something called a Bund, which is basically the German federal version of a classic bond. It's a long-term instrument, as you can see, 30 years maturity segment. It pays a coupon of 2.5%, right? And you can see some prices and an indication of the yield to the right. We're going to discuss that in just a moment. If I click on the this is the identification number, the ISIN of the security. Where I come from in Europe, we use ISINs to identify securities. Although, for example, if you're based in America, you'll probably be more used to the so-called QSIP. Okay, some more details of the bond. In the brackets over here, you see its maturity date, 2054, and it is indeed, does seem to be 30 years after the issuance date, which is 2024. So that lifespan is, or that tenor is 30 years, 2.5%. That's an emphasis on the coupon. And look, some details here. This bond was in fact, for the first time ever, issued on the 30th of January 2024. It shall mature on the 15th of August 2054. So that doesn't give you, precisely 30 years. It's 30 years plus a couple of months, but more or less 50 years. It has a coupon of 2.5% payable annually. And what else? I mean, you can have some. You can go and discover the actual terms of issue, etc., etc. But the thing I want to really draw your attention to is the fact that down here you can see that this specific security has already been sold via auction or at auction on several occasions. For the first time, it was indeed offered on the 30th of January 2024. That's when it was first created and it was a new issue. And I believe in a previous video I did mention how governments often reopen their securities. So they issue them once, sort of for the first time. That's when it's a new issue, and then they give themselves the flexibility to bring more of the same securities to the market and offer more at what is more or less regular intervals, like more or less monthly here. Every month they were reopening, meaning selling a bit more of the same security to market participants, just to retain that flexibility. You don't want to offer all the bonds in one go. You typically want to do some selling which is staggered, which is spread out over time, which is what's happening here, but it's the same security being sold at different time points, but it's a security with the same coupon and the same unchanging maturity date, which is that 15th of August 2054. So it doesn't matter whether it was sold here, here, or here. Those parameters stay fixed. Now, the last time the thing was sold was the 19th of June via an auction, and that auction delivered certain price results, which we're going to focus on. But please understand that it was also offered to the market before in previous months. So let me go back to my note, because what I want to do now is focus on the mechanics of this bond. Now, obviously, this is going somewhat outside of the curriculum, because your curriculum just talks about this in a set of sentences or paragraphs without doing too much explanation. But I think it's nice to illustrate, whenever we have the possibility, illustrate these concepts with real life data. So we've got a bond whose maturity, okay, this is a timeline, of course, and the maturity date will come on the 15th of August 2054. That's what we saw for this bond. Let's just go back and check. Yeah, maturity 15th of August 2054. Good. And over here, as you should know, all the investors holding that bond will receive what's known as the face value. These bonds get redeemed at par, or at face value. So typically we assume the face value to be 100. It doesn't necessarily have to be really 100 euros. It could be 1,000 euros, but it's a sort of symbolic 100. And what else is, investors will receive a coupon. It's going to be 2.5%, and obviously that 2.5% is applied to the face value. So if you assume the face value to be 100, then that's easy enough, because the coupon becomes 250, 2.5% of 100, and that gets paid to investors holding the bond on an annual basis. That's what we were told here, payable annually, always on the 15th of August, I guess. So nice series of payments over here. I'm not going to write that out. You'd have 30 or so payments. Right. Okay. And on the 19th of June 2024, an auction was held, but it wasn't for something completely new. It was indeed that reopening by the German government of a bond that they had previously offered in prior months. And the reason why you hold an auction is you're asking market participants to tell you, the government, what price they are willing to pay for this security. On the one hand, if you're an investor participating in this auction, you know what the security is all about. It's a fixed income instrument. It gives you a pre-programmed set of cash inflows on specific dates in specific values, and you know that the German government is promising to pay you this much in the future. What the German government wants you to tell them is how much you will be willing to pay for this specific security, or what price are you willing to bid, and how many such securities are you willing to sign up for, how many are you willing to buy. So bids are basically investors' submissions of prices. So investors are invited to the auction, and they're invited to submit, to place to send bids, offers to buy. Bids, very importantly, are can come in two forms. They may be so-called competitive bids. We'll explain that in a moment. And there is also the possibility to place what's known as a non-competitive bid. So non-competitive bids, which we'll discuss in just a moment. Okay, if you're placing what's known as a competitive bid, you are specifying, so these bids specify an acceptable price. You're telling the seller, in this case the German government or the German finance agency who's organizing the auction, what price you are willing to pay, what price is acceptable for you. And also you're telling them the number of, in this case bonds, the number of bonds you are willing to purchase, number of securities. To be purchased, how many you want to buy, at that specific price. And the problem is, because you're specifying an acceptable price, that is, I don't want to pay more than whatever, whatever number, whatever amount, it may be the case that your offer will get rejected because the price you're willing to pay may not be competitive enough. It will not be high enough. At the end of the day, the government is organizing this auction, opening itself to the receipt of bids, and then they will only accept those offers which are the best, the most favorable for them, the seller. So they will only sell to those bidders, to those investors who propose to pay the highest prices. They are not compelled or under no obligation to sell to everybody, irrespective of the price they bid. So if your price is not good enough, unfortunately, and you never know up front what good enough will be on that given day. It depends on what offers others submit, how high they are or how lower they are, and how badly the government needs to sell these instruments. So let me say here that under a competitive bid, we will not purchase if the price determined at auction, after the auction, if it turns out that the price which transpires from the auction process is higher than our bid price. So if it turns out that others are willing to pay more, the government will sell for a higher price to those others, and our offer will get rejected. Now, in the case of non-competitive bids, that's very different, because you're not specifying a price at which you are willing to pay this stuff. You just agree to purchase at the price, let's say, determined during the auction or at auction. And the thing here is, you always get to buy the securities you want, because you haven't said, I'm not willing to pay more than this much or this much. So you'll basically just buy the number of securities you want at a price that you don't know up front. You're not limiting, you're not saying anything about the price, you're just agreeing to take whatever the price turns out to be. Okay, now let me show you an example of how this could work. So, it's going to be very much based on that German bond over here. You remember, 30-year bond. And on the 19th of June, which is fairly recently, given when I'm recording this, just 3 days ago, the German government asked, what price are you guys going to offer me, bid me for this instrument, where I, the German government, am promising to pay you 100 in 30 years' time, and a whole lot of coupons, 250 per year. Well, I can imagine that they received quite a lot of offers, these so-called competitive bids. Actually, you don't have to imagine, you can actually check this, because look, the last sale was indeed on the 19th of June, okay, and if over here I click on bids and allotted volumes, you will see that on that reopening from the 19th of June encouraged or resulted in bids with a value of I guess this is 2.6 billion euros, because this is in millions of euros, 2,619 million, so 2.6 billion, of which 810 million were competitive bids, and the remainder, 1.8 billion, were of the non-competitive type, right? So 1.8 billion, the non-competitive bids being higher. So as you can see, we do indeed have these two types of bids in reality. This is something that happens for real, it's not made up. Okay, so if you're a competitive bidder, what you'll say is, oh, I'm willing to pay so much or so much or so much and buy a certain number of bonds at a specific price. And what the government does is they take all of these offers and they rank them from best to worst. Now, the bidders don't see, it's not like an open auction process where you can see what the others are bidding and whether they are bidding higher or lower than what you want to pay. So they can't necessarily see typically their bids. But let's say the government receives a bid of somebody willing to pay 99.1 times a certain number of bonds. Remember, this 99.1 refers to a bond which is promising to give a certain amount of cash flow. So 99.1 being the price I'm willing to pay for all of this stuff. And the more you study bonds, the more you get used to the fact that prices are typically quoted as a percentage of face value. So if face value is 100 euros, that makes it 99.1 euros. But if face value was 1,000, well, that would naturally translate to 991. It's just easier to work with percentages. Everything with bonds, to do with bonds, is typically stated as a percentage of face value, including the coupon. So let's say this is let's imagine that this is the best bid, the best offer that was indeed received by the government during the auction. So that goes to the top spot. Somebody else, it could be actually the same investor, but let's say somebody else is bidding 99.09 and they want to once again buy a certain number of bonds. All of these are competitive, meaning that the bidders are proposing a specific price. And of course, we will also have bids at lower price points, maybe 99.07 times a certain number of bonds. Remember, you don't just say what price, you also say what amount or what number of securities you want to purchase at that specific, willing to purchase at that specific price. And let's get to 99.05 times a certain number of bonds. I'm completely making this up because I don't know what the actual offers were. That's not made public, although we'll have some public information. I'll show you in a moment. And then, of course, presumably the government also received lower offers. Let's just have a few, 99.04 times a certain number of bids, or 99.02 times a certain number of bonds. Okay, these are ranked from highest priced to, of course, lowest price, so worst from the perspective of the seller, so lowest price. But another way to think about this, which is actually quite important, that you're able to do that kind of mental, you retain that mental flexibility, is that if somebody proposes to pay 99.1, then from their point of view, the return on an investment is going to generate the lowest yield, the rate of return. And often with fixed income securities, instead of focusing on the price, you can focus on the yield that that's going to give, because if you propose to pay 99.1 for something that will give you a whole lot of 250, 2.5 on specific dates and then 100 at the end, you can quite easily turn that into a rate of return, a yield to maturity measure. And of course, given that you pay a relatively high price, that yield is going to be quite, lower. So lowest yield here, but if somebody proposes to pay a lower price, well, that may result in a higher yield. However, the point is, I mean, if you propose a pretty low price because you want to earn more on the bond, squeeze more out of it, will you actually ever get to buy? Because the government doesn't have to accept all the offers. That's the point of the auction. And now what the government does is it goes through these offers and says, look, oh, okay, I'm going to accept your offer with this pretty high price. Well, this second price is not as good, but I'm still going to accept it because I need to borrow money as part of my, debt management policies, etc. I probably have bonds that are coming up for redemption right now, and I need to refinance my existing debt, plus I've got some current needs that need to be addressed as well, sort of fiscal imbalances between inflows and outflows, so I kind of need to borrow the money. And look, you'll keep accepting the offers until you decide, well, that's pretty much enough. Once I accept this offer, this offer, this offer, this offer, etc., etc., I've got enough. I've borrowed enough to satisfy my needs. Obviously, how much you borrow depends on the offers. Depends on how much you really need, but also on the offers that you've received. If it's a day where lots of investors sent in pretty high offers, that will give you an opportunity to borrow maybe a little bit more and give yourself a bit of a buffer for future needs, right? So this is why governments reopen bonds, because you don't want to throw, you don't want to do everything on one day. That one single day may not be a good day in the markets, and maybe investors will not be so willing to send high prices. If you phase things over time, that gives you more flexibility to capture the right conditions when, capture some borrowing when the conditions are right, and when investors are optimistic, willing to give you a high price, etc., etc. In this specific case, let me go back to the bond and the auction results. Look, we are told that the lowest accepted price down here, lowest accepted price was 99.05, which means when the government was going through these offers and saying, oh, I accept this one, this one, this one, they kind of stopped here. Lowest accepted price, which in many places is also called the stop price, lowest accepted price, known as the stop price as well. And the point is, everybody who gave or sent a bid, sent an offer that was higher than or equal to that lowest accepted price will have their offer accepted. These are the people, or these are the offers where the bidders actually end up buying. Those who sent in offers, or those offers which are below the stop price, they get rejected, and these, let's say, these investors do not buy. So as you can see, that's the point here. You specify an acceptable price and the number of securities in a competitive bid, but you face the risk of not purchasing the bonds if the price determined at auction is higher than our bid price. So obviously, the price determined at auction, this statement or this phrase over here means that lowest accepted price or the stop price. On the other hand, if you are one of the non-competitive bidders, meaning, okay, you don't specify what price you're willing to pay, you just agree to purchase the price determined to purchase at the price determined at the auction. Well, the non-competitive buyers just conform to the results of the auction, and they buy at the price determined at the auction. They've got no way of influencing it; they just comply with it. Right. Hopefully that's okay for you guys. Now, I want to mention one more thing, which is really important, and that's going to be the end of the sort of the technical aspect of it. Those competitive bids, so the ones where you specify a price that you're willing to pay, they work or they play out slightly differently depending on the auction format. There are two auction formats that apply to competitive bidding. One is the multiple price auction, and the other is the single price auction format, or uniform price. I mean, where I live in Poland, it's called the uniform price auction. Doesn't matter. Your book calls this the single price auction, and that's absolutely fine. Now, in a multiple price format, the successful bidders, the ones whose offers were accepted, okay, successful bidders, and in my little hypothetical example here, which is somewhat anchored on to reality or somewhat based on real numbers, but the only number I am sure of is this 99.05, because that was indeed published by the German government as the lowest accepted price. The rest is I've made up, right? But the successful bidders, who in this example would be the bidders or the bids 1 to 4, okay, must pay the price which they proposed, which they bid. So if you told the German government, I'm willing to pay you 99.1 per bond and buy or procure a certain number of bonds, then the government goes, okay, you're successful, okay, so pay that 99.1 which you were willing to pay. And that's kind of quite intuitive for most people. But, and this is the reason why when the German government publishes the data on the issue that happened, they provide you with the lowest accepted price, but also they tell you the average price at which the buying was done. And the average price, as you can see, is typically, if you look at sometimes it's equal to the lowest, but the average price is typically slightly higher than the lowest accepted, because there are buyers who end up paying a higher price than the lowest accepted, right? In that case, it was 99.06. But there is also this format, the single price auction, which is quite interesting, because here the successful bidders, and once again they are the people behind the bids number 1 to 4, they end up paying a uniform or single price. All of them buy for a single uniform price, and look, the single price at which all of them will be forced to buy cannot be an average. It cannot be something in between, because if number 4, the bidder behind the fourth bid, said I'm willing to pay 99.05 only, you can't force them to pay anything other than 99.05. But you can definitely force, nobody will mind, those people who propose the higher price or higher prices to pay that single uniform price, which is the lowest price accepted. So what will happen is they will not pay 99.1. They said we're willing to pay 99.1, but in the end they'll not pay this price. These guys will not pay this price, and this person will not pay this price. All of them will pay the lowest accepted price. It's the lowest accepted. That's what happens in a uniform price auction, right? Or single price auction. Just have to be aware of that technical aspect of it. And certain countries hold multiple price auctions. Others hold single price. Where I come from, Poland, we've got a single price auction. In Germany, they've got multiple prices. Countries sometimes change between the formats. My country, Poland, did that many years ago. I think your book talks about the Indian government changing formats as well. So, changes happen, and there are the two different formats to choose from. Okay, so let's just very quickly run through the process of holding these auctions. First of all, you announce the auction. You need to tell potential buyers, potential investors what you're going to do with some, in advance. And this announcement will include information about the debt securities. It's not always bonds, it could be shorter term instruments, right, to be issued. So, for example, I told you I'm recording this on the 22nd of June. And up here I've got another example. This one coming from the US. It's the website called Treasury Direct. This is an American government website, and you've got info here about upcoming auctions. The American government showing us what to expect, and for some of these, the ones that will be up for sale, relatively soon, like 24th of June, 24th of June. Today, what I'm doing, this is the 22nd, and it's a Saturday. So the 24th will in fact be a Monday. So that's already been announced. It was announced before the weekend. And you can see how much is going to be offered. You can click on the details of the instruments being offered. They are 13-week and 26-week bills. Also, the American government is already telling us we'll be issuing, on an auction that will happen on the 25th of June or 26th of June, we'll be issuing some longer term instruments like notes, no scheduled bond offerings. So this is announcements. And then the auction itself happens a few days later, typically. Now, the auction is when investors, these could be financial institutions. We'll talk in a moment about somebody called primary dealers who play a big role in this. But in some countries, also individuals get invited or can participate in the auctions. And an example of such a country is the US, where via this system called Treasury Direct, you can actually place offers, even if you're an individual investor, so you can place bids. So investors place or make their bids, their offers to buy, competitive or non-competitive. And as we said, once those offers are received, we determine a price, and all of the non-competitive bids are accepted, plus some of the competitive bids get accepted as well, but definitely no assurance that all of them will be accepted, and typically not all of them get accepted because some are for prices which are simply too low. And once we know who was the successful buyer and who wasn't, once we know what the price is to be paid, we can actually settle the transaction. But that happens after a few days, typically after the auction. So here, even though an auction for these short-term securities will happen on the 24th of June, I'm just looking at the first top row here, 24th of June, that's a Monday. The settlement, the actual delivery of the securities, their issue and receipt of payment will happen a few days later, 3 business days, 3 working days later. So that's a separate sort of step. The securities are issued by the government and delivered to the buyers, to the successful buyers, obviously in exchange for payment. And that's what often is described as the settlement, which happens after, not on the same day as the auction itself. Okay. Now, I've mentioned this phrase, primary dealers. What you'll have in the majority of countries is a group of financial institutions. So let me write this down. It's a group of financial institutions. Typically, they're going to be big banks operating in that country, but often also banks which are members of a more international framework or group of financial institutions. And they are required to participate in the auctions, actually in all of the auctions, by submitting competitive bids. So if you're thinking, okay, who is submitting the competitive bids? Because the competitive bids are the ones who kind of form the price. If you submit a non-competitive bid, you just agree to comply with whatever the competitive bidders' actions bring about in terms of the price. So who proposes the prices? Who sends the competitive bids? It's financial institutions, and they're often called primary dealers. And once again, I've just decided to show you an example of this in another country, European country, Belgium, that I have some dealings with as part of my training activities. The Belgian Debt Agency, once again, the body that's responsible for issuing government debt on behalf of the Belgian government, has the following list of primary dealers, at least in 2024. You can see they are not necessarily only Belgian banks. You see Citi over here, Deutsche Bank, Bank of America, Securities, both are. The French BNP Paribas, lots of banks from pretty much around the world who are interested in participating in these auctions and having some kind of impact on the price. Whereas if I go back to the, let's say the German example here, the dealers are called, primary dealers form what's known as the Bund Issues Auction Group, sorry. And they are the ones who participate in the auctions, and it's a much bigger 32 strong list of financial institutions. Those are the ones who participate in the auctions. Now, in some countries, the auctions are limited to these types of bidders only, the primary dealers. However, some countries open this up to others, like, as I told you, in America, and I guess in some other countries as well, even as an individual, you can participate via Treasury Direct, the system, in these auctions, whereas in other places, for example, where I come from, Poland, the participation in the auctions is only limited to the big players who are on the list. They are the ones who can appear at the auctions. Others can't. But that's not, don't worry, you don't have to know which countries work under what system. Let's now just quickly discuss secondary market trading. So once those securities are already issued, what happens next in the secondary market? Okay. Well, the thing about bonds is they mainly trade over the counter, meaning away from organized exchanges. And those who kind of organize that trading are dealers or brokers. Dealers are the ones who buy from people and sell. So they, whenever somebody wants to sell, you go to a dealer, you sell them your bonds, the bonds you're holding, and then the dealer waits until somebody appears who wants to buy, and they sell from their own inventory. Brokers are, classically speaking, and you learn more about this in the equities section on the market organization. Brokers are the people who connect buyers and sellers. So if a buyer wants to buy, a seller wants to sell, a broker will kind of get them together and arrange a transaction, but they are not buying from one side and selling to the other. For a fee, they're just arranging the trade. Anyway, however, there are some exceptions to this. Sometimes government bonds do trade on exchanges. Sometimes also on exchanges. And a notable example that your book gives is Australia, where government bonds trade on an exchange, but that's an exception rather than the norm. Okay, what is more? So these are some very loose points, from different aspects of secondary market trading. Typically, government bonds, because the government, is typically the largest issuer of debt in a country, So typically, not always, typically the government is the largest borrower of money, stroke issuer of debt securities in a given economy, in a given country. Securities, okay. Government bonds are typically the most liquid debt security out there, meaning they trump, for example, corporate bonds in terms of the volume of trading and the liquidity with which they trade. And if you want to do some more differentiation here, there is also some variety here, because not all government bonds will be as liquid as others. It's typically the most recently issued bonds, those most recently issued securities, which we refer to as on the run securities, that are going to be most liquid among what is already a liquid group, most liquid. And very importantly, you may remember when we discussed corporate debt issuance or corporate bonds generally, we talked about corporate bonds trading or being traded at a premium in terms of the yield to government bonds because of the higher credit risk involved. And I drew a yield curve, which was the government benchmark yield curve. Well, it's these on-the-run securities that we use to form our opinion about how that government yield curve looks like, what that government yield curve looks like. So let me just for a moment go back to this German example. On the 19th of June 2024, the German government issued a fresh batch of these bonds, getting a price on average of 99.06. But that 99.06 results in a yield for investors of 2.5% or 2.54%, meaning these investors were happy to propose a price and pay a price which, given how the security is structured, what it will bring in the future, gives them a locked-in rate of return. We call this the yield to maturity, although whether that's locked in or not is a slightly contentious thing. That depends on how you reinvest the coupons, but it gives you 2.54% per year rate of return or yield. Now, if a corporation was to issue 30-year bonds, surely they would have to offer a yield which is at least a bit higher, given the higher credit risk that a corporation sort of poses for investors. But the fact that the Germans have recently, as a government, issued a bond, a 30-year bond with this yield, gives us an idea of what to expect and how to price corporate bonds. So it forms a certain benchmark for us. And obviously the German government doesn't just issue one type of bond, it also issues many other types of bonds at the same time. So when you look at issuance results, you will see that there are different maturities, 30-year, 12-month, 10-year, etc., which the German government constantly brings to the market, so as to for us all to be able to form our expectations of where the benchmark government yield is. So let me say this over here. Hopefully the explanation was enough, but let me also write this down. Used for government benchmark yields, which help us price non-government financial securities or instruments as well. Okay. So the most recently issued securities are called on the run. They are the most liquid, but you'll also have trading in the market typically some previously issued securities. They are called off the run. Just know the name, off the run versus on the run. These are definitely less liquid, less trading happening in them. And one point which your book makes is that if there is a lot of liquidity as is the case with on-the-run, then a lot of the time these on-the-run securities are traded via in sort of electronic marketplaces, which are a bit like an exchange. They're typically run by banks, because when there is a lot of liquidity, it means there are a lot of buyers and sellers who simultaneously want to trade. And then it's easy to say, oh, here's a buyer, here's a seller, let's connect you, let's do a trade. Whereas with off-the-run securities, where there is definitely less interest from the buyers and sellers, such connections cannot be really made in real time. So with off-the-run securities, which are definitely less liquid, there will be more of a call for dealers, because dealers, whenever somebody wants to sell, they buy, and then they face the risk, or they have to wait until a willing buyer arrives. So somebody sold to them, the dealer holds the thing on their own inventory, and then they need to attract a buyer. And you don't know whether that buyer will come in a couple of hours, a couple of days, or maybe even longer, because these securities don't trade so in such a liquid way. Dealers bring liquidity to the market because they allow people to sell and buy whenever they want, but they kind of have to they carry the risk of holding these securities in the meantime. And one of the ways in which dealers can fund that holding of the securities which they have in their inventory is via repo, something we discussed in the video called repo applications. Okay, anyway, final point here. I'm getting very carried away because I really like this topic. This is something I deal with on a day-to-day basis. There is, or teach on a day-to-day basis for non-CFA clients. There is a notable difference that your book talks about in the trading of corporate debt. Versus sort of sovereign government debt. And it's not a very obvious point if you kind of haven't seen it being talked about, but it's a point that your books make a big thing out of, so to speak. So you have to know it. Whereas corporate debt is held for pretty much the reason that you want to make money off the back of it, etc., purely sort of financial reasons. Sovereign debt, on the other hand, will often be held or bought by people who don't necessarily, or institutions who don't really have purely economic reasoning behind the purchase. So let me write this down and let me explain. This is bought for various, also non-economic, your book talks about, objectives. What do we mean by that? For example, central banks often buy government securities to conduct monetary policy as part of their monetary policy operations. It's called open market operations, to conduct monetary policy. More on this in the economics section of the curriculum, monetary policy. So they use these sovereign debt instruments as a tool to conduct monetary policy. What is more, foreign countries will often buy government securities of a specific nation to invest their reserves. As I mentioned in a previous video, I think in some previous video, where I come from, Poland, the Polish Central Bank, the National Bank of Poland, has plenty of US dollar and euro and Swiss franc foreign currency reserves, which are invested primarily into US government bonds, euro sovereign bonds, for example, those coming from Germany, as well as Swiss government bonds as well. It's quite a natural thing for countries to do. And Banks, normal commercial banks, often buy and hold sovereign debt. So once again, when I say buy over here, I mean the buying of sovereign debt, sovereign bonds, sovereign short-term securities, etc., to meet certain regulatory requirements. There's often a regulatory requirement in many countries for financial institutions like banks to hold some liquid, good quality government securities. It may not be a very strict requirement. It's not said that you have to hold a certain amount of bonds, but you have to hold a certain amount of good quality, safe fixed income securities that are quite stable, liquid, and in the end it ends up being government bonds that you actually hold. So these are the so-called not purely economic reasons for which sovereign bonds are held by different entities as opposed to corporate bonds. And because, this creates additional demand for such sovereign bonds, the borrowing costs faced by governments, by sovereign issuers, are definitely going to be lower as a result, are lower for governments. Obviously in comparison with corporate issuers than for corporates. Because of that higher demand, the price at which those securities trade, they are sold, is higher, okay? And this is going to be especially the case, or especially true, for those governments, for those government issuers who happen to issue their securities in what is known as, in what is one of the reserve currencies, globally accepted reserve currencies, with reserve currencies. That is, currencies in which other nations tend to hold their reserves. So as I told you, I come from Poland. The Polish zloty, the Polish currency, is not necessarily held by others as a store of wealth, as opposed to things like the dollar, the euro, etc. But if the Polish zloty were a globally accepted so-called reserve currency, then there would be an additional source of demand for Polish government bonds, because others would buy it just to hold their reserves in those bonds. So if a country has the privilege, let's say, of having a reserve currency, such as the US dollar, so America, the US enjoys this privilege, Japan has the Japanese yen, and other people around the world hold the Japanese yen as a reserve currency, and they invest those Japanese yen into safe government bonds. Same thing for the euro, same thing for the Swiss franc, the British pound to a large extent as well still. The Australian dollar is another example, and actually in more recently the Chinese currency, the renminbi, is also growing in importance as a global reserve currency. You've got yourself an additional source of demand for the bonds, so that lowers borrowing costs. Okay, so hopefully you enjoyed this video and the examples I was showing you. Please, if you're watching this video on a much later date, don't be discouraged by the fact that they may now be out of date. Just go to the relevant website and look for yourself. The mechanics of how auctions work stay roughly the same. So this video should have universal appeal, irrespective of when you actually watch it.